is 1 for 1. Okay. Now, if you have to put a 50 pip stop on the trade you're about to do, your target must be at least 50 pips away, or you have to pass on the trade, even though you know it's going to be a good trade. Okay? Because you will break a rule here if you do it. You must also be committed to staying in that trade for 50 pips. No clicking out for 5 pips, because now your reward is 50 pips. Your risk was 50 pips for 5. Really breaking the rule. All right? Can you commit to staying in a trade for 50 pips if you put a 50 pip stop on it? That takes discipline, and that's one of the hard things that traders have to do. Now, the third important question is, can you live with these rules? So we're going to take the safest ProAct trade, and we're going to add margin management into it. Okay, so here's a chart, and the safest ProAct trade is the break of the S2 to the S3 and on. Okay, the market has a hard time breaking the first and the second support going down. It's just a reverse going up. It's the first and second resistance. Okay, but once it breaks the second resistance, it usually doesn't have a whole lot of problem coming down. Okay, so the safest trade is the break of the S2. Okay, so where do we get our first trade? Right here. And we get the first trade, which is the arrow and the painted candle, on the break of the S3. Now, we now have to assess our risk. Our risk would be above the last resistance. So now we know where our risk is. Now, our whole goal now is, does the target has to be equal to that space? And we can see the target is greater than that. So this would be a great trade to make, okay? And you can see, there's your risk. There's your reward. And you can see it's about a 1 to 2 ratio. That is a good trade. Here's another one going up. Now here the currency has a hard time getting out of the R1, R2, but once it breaks that, then we can usually pretty well go. Okay, so our first trade is the break of the S2. We already have a wild card in effect, so we're easily we can enter this trade at will. But now we first have to do is assess our risk. Our risk is the last support, and below that, about 5 to 7 pips. Okay, so now we see that this target right here might be a little different. That's the difficult. That's the R3, because there's our risk and there's our reward. So we can see that our risk is greater than our reward. So the only way we can take this trade is if we target the R4. All right. Now that means you got to be committed in that, and it may take it 2 days to get there. So if you make this trade, or you make the second trade, which is right here, this is the next wild card right here, the only way you can make it is if you're committed to the R4. All right? Now if you get stopped out trying to get to the R4, that's okay. The point was you were disciplined and you targeted that, and you did risk and reward based on that target, not this target. It also means that you cannot click that trade out right here. Even though it goes to sleep for 6 hours, you've got to live with this trade. Here's another one, once again going up. Hard to get out of the R2, as you can see. Okay, so now we get our trade right here. That's the dot, and we already have an arrow and a painted candle telling us that momentum is already in the market. We can now look, where's our risk? Our risk is the last support. Well, that's a great little risk. There's hardly any risk for reward. All right, so here's our first target. Can we make this one? Not at this level right here. Okay, because we're too close to the R3 to make that trade. Therefore, we have to be committed to going to the R4. All right. Now, if we do that, we have to say we're not clicking out when it hits this R3 and starts bouncing around here. We'll expect it to bounce around and expect it to go to there. And the greater trade, of course, is all the way to the R5, and you can see that's exactly what it did. So there was the trade right there. All right. Here's another one coming down. All right. So here's our break of the, we're now breaking the S3 right here. We got a dot that tells us that momentum is entering the market. The arrow and the painted candle tells us it's okay to look for this trade. So that would be our first entry level. All right. We go back and find the previous resistance and go up above it about 5 to 7 pips. Now that will give us our risk. Now once we know what our risk is, we can then determine if a reward is even worth making this trade. Okay, well the reward is all the way down to here. If you only take it to the R4, you cannot make this trade. But if you commit to taking the R5, then you can make that trade. Right? And actually it continues on even further. Right? So can you see why we stress that you must stay in until the targets are hit? Unless you do that, you break margin management rules. And if you break margin management rules, you now have to be right 90% of the time, which is an impossibility. Therefore, you've got to stack the deck where you don't have to be right, but you stay into the targets. And if the targets are 1 to 2, 1 to 3 away, and you make enough of those a year, it will offset any of those $100 or $250 or whatever you're trading at level losses. So how do you adjust when you get in a choppy market? The ones I just showed you were nice, they're real trending. Ooh, what do you do? That's really great, okay? But what about a choppy market, okay? Which, by the way, is 70% of the time. Well, now you've got to plan your trade and scale out at predetermined levels. You will bank smaller profits, but stay into the targets, and most importantly, reduce your risk. In a choppy market, the market is not going to rock and roll. It's just going to go a little ways and stop. All right? So how do you do that? You move the stops as soon as possible to break even, and then as you continue in profit, up 15 pips. All right, so let's take a look. If you start with multiple lots, multiples of 3 are best. 3, 6, 9. You can do 9 micros, for instance. It's not even 1 mini. You can trade at this level until you get used to it, okay? And after your entry, you could take 1/3 of it off at 15 pips and move your stop to 0. Now, the worst that can happen is 1/3 of your trade made 15 pips, and the rest are in there trying to go to the targets. But you can't lose. If it slams right back, which it has a real high tendency to do in a choppy market, you're going to break even on the rest of them, but you still made a profit for the day. Then take another 1/3 off when it hits the next T30 or a support and resistance zone, or maybe a fib extension. Then you would move your stop to a significant profit and ride the rest with a trailing stop representative of your currency cross. For instance, anything with the British pound in it has to have a minimum of a 50 pip breathing room. Minimum. Okay? So if you can't afford for that thing to go back 50 pips, then don't trade a British pound. Go trade the Australian dollar. Now this requires that you plan all of this ahead of time, and that is a good thing. So let's take a look here. I've got a little chart up here, and right here we're going to take our entry. Wow, we're breaking the S1 right here. We've got a wild card in play. The dots are there telling us to go, and we've got a wild card right here. Can't break it till it breaks this target and tells you we're going to go to the next one. We now know that our target is the next line, which is the S2 in this case right here. So we'll enter with 3 lots, and we'll put our stop above the last resistance. Now that tells you right away that whatever this space is, the target's got to be equal to it or greater. Right? If that isn't the case, then you can't make this trade. Right? Now, so we'll set our stop right above this line right here. Right? Now, as soon as we hit the first target, which is this T30 right here, we'll take a profit on 1 lot, and we'll now move our stop to break even. And if it comes right back screaming up here and hits this thing, we've made 15 pips on 1 lot. Okay? Now, that's not the same as you clicking out for 5. This is where the market takes you out. You can't do anything about the market, but you can do something about your trigger finger. All right, your goal is to stay in for the target. All right, now the target, it flops around here at this first target and moves over here and finally hits the T30, which is the next target right here. We'll take 1 lot off again right here, and we'll move our stop down here to profit, so nothing can happen. So what did we do? We took 15 pips on the first trade, we took 40 pips on the second trade, and we still got 1 lot still in. And if this turns right back up here and takes us out here, we'll make about 90 pips. And if it continues to go, we have 1 lot in for the next target. And that's how you trade a choppy market, because you don't know if this thing is going to break or it's going to come right back up into this range right in here. And that'll protect your profits and reduce your risk. The name of the game, folks, is reducing risk. And it's not about finding the reward. The reward's easy to find. Managing your risk is the tough thing. It takes discipline, and it takes pre-planning, and it takes you determining what your risk is and your willingness to adhere to those rules and not break them. So, thanks for paying attention on this.